Understanding the strangle option strategy. A strangle is an option strategy that involves simultaneously buying or selling both an out-of-the-money OTM call option and an OTM put option with the same underlying asset and the same expiration date, but different strike prices. Out-of-the-money, OTM, call, a call option with a strike price higher than the current market price of the underlying asset. Out-of-the-money, OTM, put, a put option with a strike price lower than the current market price of the underlying asset. The core difference between a strangle and a straddle is that a straddle uses at-the-money, ATM options, same strike price as the current market price, while a strangle uses OTM options, making it generally cheaper to enter but requiring a larger price movement for the long strangle to be profitable, or a smaller price movement for the short strangle. 1. The long strangle, betting on significant volatility. Goal: to profit from a large price movement, either up or down, in the underlying cryptocurrency without necessarily predicting the direction. This strategy profits when realized volatility is greater than the implied volatility priced into the options. Market outlook: expect significant price swings, often around major events, e.g., protocol upgrades, regulatory news, major macroeconomic announcements, where the outcome is uncertain but expected to cause a drastic move. Profit potential: unlimited on the upside, substantial on the downside, as the price can fall to zero. Maximum loss: limited to the total premium paid for both the call and put options, plus trading fees. Step-by-step process for a long strangle to aim for minimum profit. 1. Choose an underlying cryptocurrency. Select a crypto asset, e.g., Bitcoin, BTC, Ethereum, ETH, that you anticipate will experience significant price volatility in the near future. Look for assets with upcoming catalysts but an uncertain directional outcome. 2. Select an expiration date. Choose an expiration date that gives the underlying asset sufficient time to make a substantial move. Typically, this would be a few weeks to a few months out, as time decay, theta, works against you in a long strangle. A longer expiry allows more time for the move to happen, but the options are also more expensive. 3. Identify out-of-the-money, OTM, strike prices. O. Buy an OTM, call option. Choose a strike price moderately above the current market price of the cryptocurrency. O. Buy an OTM, put option. Choose a strike price moderately below the current market price of the cryptocurrency. O. Consider equidistant, strikes. Often, traders choose strike prices that are roughly equidistant from the current spot price to maintain a more neutral initial delta. 4. Calculate total premium, net debit. Sum the premiums paid for both the call and the put options. This total represents your maximum potential loss. Example: if BTC is at $60,000, you might buy a $65,000 call for $500 and a $55,000 put for $400. Your total premium paid, max loss, would be $900. 5. Determine break-even points. Upper break-even. Call strike price plus total premium paid a lower break-even. Put strike price, total premium paid example from above. Upper break-even equals $65,000 plus $900 equals $65,900. Lower break-even equals $55,000. 9 equals $54,100. For profit, the price must move beyond these break-even points. 6. Monitor the position and implied volatility. Price movement. Actively watch the underlying cryptocurrency's price. If it makes a swift and significant move in either direction, one leg of your strangle will become in the money, ITM, and gain value. Implied volatility, IVU. An increase in implied volatility generally benefits a long strangle, as it increases the value of both options. If IV drops, it works against you. Time decay, theta. Be mindful of time decay. As expiration approaches, the extrinsic value of both OTM options erodes. 7. Exit strategy, aiming for minimum profit. O. Early exit on significant move. The ideal scenario for a long strangle is a rapid, large price move. If the cryptocurrency moves significantly in one direction, causing one option to become profitable enough to cover the initial cost of both options and provide a profit, you can consider closing both legs of the trade. O. Partial close. If one leg becomes highly profitable, you might consider closing that leg to lock in profits, while letting the other, now likely worthless, leg expire or closing it separately. However, for a minimum profit strategy, closing both simultaneously once the net profit target is met is often simpler. O. Avoid holding to expiration. Unless deep ITM. Unless one option is deep in the money and guarantees a profit that exceeds your initial debit, holding a long strangle until expiration often results in both options expiring worthless or near worthless if the price doesn't move enough. O. Predefined profit target. Set a specific percentage of your initial investment as a minimum profit target, e.g., 20% of your debit. Once this target is hit, close the position. To get minimum profit with a long strangle, the key is to enter when implied volatility is relatively low, making the options cheaper, and exit when there's been a swift, substantial price move, and ideally an increase in implied volatility. Don't wait for the absolute maximum profit if your goal is consistent minimum gains. By understanding these strategies and employing disciplined risk management, you can aim to generate consistent, albeit potentially smaller profits in the volatile world of cryptocurrency options. Please like, subscribe, and comment.